2-bedroom, something that's kind of average, considered average, or, just considered average in general, when I can just be in my own personal space, my own home, have a garage on top of that, because I'm sick of waking up to pollen all over my car. I mean, just that freedom, you know what I mean? For him and for me, most definitely. That's like my number one thing. I'm like, it's time. Like literally, it's past due at this point. So, that's the biggest benefit for me. Just to have something to grow up in, especially although he's 15, just still something that he can say is my home. That's most important. That's most
Exactly.
important. Yes,
Exactly.
ma'am.
Yes, that is definitely understandable, especially that you hit on the fact of rental prices going up. It is bizarre. It's really crazy. And so it is to that fact, as much that most people are now transitioning to have to pay for a 2-bedroom apartment. It's like, yeah, they are almost very what and what with home ownership. And it's nothing like you said, being able to pull into a garage. So I'm from Ohio and it snows. So a garage was a big thing for me. I was like, I have to have a garage. I don't want to have to walk in the rain, walk in the snow, all those things. And then, like you said, it's for your family, you and your son, to create a more conducive environment. Who wants to keep fighting over the bathroom? Like, I care about my appearance. I got my makeup to do, and you're stuck.
Girl.
You're in the bathroom. So
Right.
I definitely, I completely understand your reason why. So for you, whenever things, that you hit a rough patch in the road of this journey, just keep reminding yourself, I'm doing this for me and my son. It's bigger than this inconvenience. It's bigger than,
Right.
this wrench that was thrown my way. It's bigger than that. So that is your why. Anytime, something doesn't go as planned, just keep telling yourself, I'm doing this for me and my son. And that's what's going to keep you going and motivated to continue in this home ownership journey. So thank you for sharing.
Yes, yeah. Absolutely.
All right. So moving on. There we go. All right. So what we're going to be talking about is the brief overview starting right now is of the home buying process. So first and foremost, you definitely want to contact a realtor. The reason you want to contact a realtor is because a lot of times we have our own preferred group of people that we work with, meaning we have vetted them. We know the type of quality that they will provide you with. We know the type of customer service they will provide you with. We know these people and we have worked with them. So we know what to expect. So a lot of times contacting your realtor puts you in a position to not have to guess a loan officer. A lot of times we see ads on TV for certain companies, or we were walking or an internet loan officer reached out to us. However, you don't know like their particular work quality. You don't know the type of customer service that they provide. Us as realtors, at that point, we will have weaved through all of, those loan officers that are not so good. We know, a lot of time the industry norm of who has a great reputation in the industry, who is getting these good reviews, who has provided my customer with the best experience, meaning they were patient with my client. They answered the phone for my client. They answered the phone on the weekends and after 5 for my client. They explained what was going on to my client. They were kind. They gave updates. So that is why you want to contact your realtor, because we have a database, and contacting us allows you access to that database so that you know that you are working with people that have been vetted, and your agent or realtor is already knows what that they will provide you with a great experience. Many of us have heard horror stories about my loan officer did this, he never answered the phone, he never explained this, my loan busted out. And it's like, I don't work with those kind of loan officers. The loan officers that we work with, and that is why we have Darryl on the call today, is because he has a reputable, he has a good reputation in this market. His company has a good reputation in this market. And all of those types of things matter as you start putting in offers and searching for your home. Because if we send your offer and it's an offer with a company that doesn't have a good reputation for issuing pre-approvals and closing loans, then that's going to be a red flag to the listing agent. So every person in this transaction has a job, has a role, and that is, that's to get you to the finish line in the best possible way, the most effective way, by providing you a great experience. So Contacting your realtor. After reaching out to your realtor, you definitely want to contact your loan officer to complete a loan application and obtain a pre-approval. And the reason being is because you don't want to start shopping for a home and not know what you're shopping for. It's kind of like shooting darts in the dark. You want to know that when you go to visit a home, that you already have your documents reviewed by a loan officer, and you know without a shadow of a doubt, this is a home that you can afford. Because there's nothing worse than falling in love with the home and then finding out later, oh, this won't work for me. The numbers won't work. So, those types of things. Isabella, I got your message. Yes, you can, I will send a replay at a later date. But yes, so that's why you definitely want to contact your realtor, get access to their database, reach out to the loan officers, complete the loan application. And then starting the home search process starts, making an offer, home inspection, home appraisal, home insurance, final walkthrough, and closing day. So I'm going to go through right now and expound on each of these areas a little more individually. All right. So what does it even mean to submit a offer? So basically what happens is after you have your loan approved, you have your pre-approval, and the home shopping process starts, meaning we are actively going out, viewing these homes in person. If a virtual tour is needed, a virtual tour is needed, but we're viewing these homes and we're active in our home buying search. And once you found the home that you love and that you want to be your forever home, and that you want to take that next step with, that means it's time to put in an offer. So basically, an offer is basically you telling the seller as a buyer, hey, I want to buy your home, but I want to buy it under these conditions. So under those conditions basically mean you're telling the seller how much you want to pay for the home, what type of financing you're using for this home. Are you asking for any closing costs? Who's going to pay for the title policy? How soon do you want to close? So all of those things will be laid out. You're laying it all on the line to the seller in an offer. That's what that means. You are telling him him or her, the full terms in which you want to submit an offer. So basically what happens is after you submit an offer and you laid out all the terms and everything, who's paying for what, once everybody agrees, it's now called a contract. So it's just an offer. When it's an offer, it's only your signature on there presenting to the seller what the terms and conditions of how you want to purchase their home. That is an offer. It's not an official contract until the buyer and the seller both sign off. It's stamped and dated and executed. So submitting an offer is just laying everything on the line to tell the seller, the terms and conditions in which you want to purchase their home. So after you submit an offer and everybody agrees to everything, what happens is we now transition to what's called your option period. And what the option period does is basically it sets a specified number of days in the contract that allows a buyer to terminate the contract for any reason, right? For any reason. However, you do have to pay the seller for that. Right. So the benefits of having an option period is, again, because it allows you a specified amount of days. Typically, it's about 5 to 7 days to have the option to terminate your contract or to move forward with your contract without risking your earnest money deposit. So basically, an overview of what the option period does is it provides security for the buyer. It has agreed upon number of days. It starts at the beginning of the purchase contract period. It requires a fee. Typically, that fee is about $100 to $200. And then at that point, the property will be placed in option pending status on the MLS. So oftentimes, as you guys are searching for homes on the MLS, what happens is you see statuses that says available or under contract, option pending. If it says option pending, it means they're still in the beginning stages. They're under contract, but they are in that phase of which they can terminate without risking their earnest money. And then if for whatever reason the option period needs to be extended, it can be extended by the buyer and seller in writing. And then it ends at 5 p.m. local time. So again, the option period happens after the buyer and the seller have agreed upon the terms in the contract. They have both signed off on it. After they've both signed on it, it's executed, meaning it's no longer an offer. It's now a contract. And then your option period starts immediately the following day. So let's say, for example, your option period, you had a contract that was executed today on April 23rd. Your option period will begin April 24th. So again, it's just basically a specified amount of days that allows you to have the option, the flexibility to terminate a transaction for any reason within that specified amount of days. After your option period, or once an offer is accepted by all parties, basically you sign the contract, initial every page and every change. The sellers must initial all changes. And once everybody has signed, the contract becomes executed. And then the execution date starts the clock ticking on the option period. So again, the day your contract is executed is not the day your option period starts. It starts the exact next day. That is when your option period starts. So you have if it's a 7-day option period, you will have the 24th, 25th, 26th, 27th, 28th, 29th, and the 30th at 5 p.m. to terminate your contract for any reason without being penalized or risking your earnest money. After a contract is executed, that option period, a lot kind of happens very quickly in that option period. The reason being is because one, we only have maybe 5 to 7 days. Sometimes some sellers allow more, but in this market right now, the shorter the option period is what a lot of sellers are preferring. So after a contract has been executed, within 3 days of the execution date, the buyer, your earnest money, and your option fee must be delivered to the title company. So for example, if today's day and your contract was executed on the 23rd, you have the 24th, 25th, 26th to deliver your earnest money to the title company. So the earnest money is basically a deposit for a property, and it's typically 1% of the contracted price of the home. So if you have a home that's $200,000, your earnest money would be $2,000, and that $2,000 would be due within those 3 days. So that is an important thing to remember, because when I first got into real estate, like 5-6 years ago, before I had different checks and balances systems, I had a client and they went under contract, and I'm sending them, your earnest money is due at this day, your option fee is due at this date, this is your closing. And what happened was they were like, we don't have that money yet. We still have to pull it out of our 401k. We didn't think anything would be due until closing. And so that poses a major problem, because if you don't have that option fee and earnest money, number one, you're defaulting on the contract automatically, and you're defaulting, so the seller can terminate your deal. So that's why it's very important to, have these types of conversations with, and attend these types of webinars, because sometimes it's information that people don't know because they think they don't need anything until the day of closing. So again, after the contract is executed, within 3 days, you turn in your earnest money, which is basically your deposit on the home. It goes to the title company. And basically what it does is it safeguards the interest of the buyer and seller. And it shows the seller that you are serious about buying the home. So, if somebody says, I'm going to take my home off the market, then we need to know that you have some skin in the game and you put your deposit down. And I know that we don't have anything to worry about, but if you do, then we have a little earnest money, making sure that, you have some skin in the game, and you have a reason to do everything that this contract says, because you don't want to lose your earnest money. Also, your option fee is due. So again, the option fee pays for your option period. So the option fee is an additional payment made by a buyer to the seller, and it allows the buyer the right to pull out of the deal for a certain period of time. So even after you've signed the contract, you can still terminate in your option period for whatever given reason. However, you have to pay a fee for that seller. So typically it's between $100 and $300. A few years ago, 100 was the industry norm, but right now it's about closer to like $250 recently. That option fee is non-refundable if you terminate your contract. It's a way of saying, okay, thank you, Mr. Seller, for allowing me a time frame to do my due diligence, get my inspections done, and you taking the home off the market. So that's your fee. That's your fee. However, if you do move forward with this transaction, then your option fee will be refunded to you or credited to you via your closing costs. So you'll see a deduction on your, your final settlement showing that that option fee was credited to your closing costs. As well as the earnest money. The earnest money doesn't just disappear, it gets credited to your final number as well. And if anybody at any point has a question, needs me to pause, needs me to reiterate something, feel free to take yourself off mute or drop it in the chat, a question in the chat, and I will be sure to answer it. All right, so during this option period, again, at this point during the option period, you are essentially, like we said, allowed to terminate the contract. You have the option to move forward or to not move forward. So what will happen during this option period, that 7-day option period, is your earnest money is being delivered to the title company. Your option fee is being delivered to the title company. Your inspections take place. And then also after you get your inspections and you get the report back, based on that report, if there are any repairs that you want to be made, you want the sellers to repair, we request those repairs during this option period as well. So a lot kind of happens in those first 5 days. Of course, me as your agent, I will always be on top of that. There's never anything to really worry about. I make sure, I send you my list of inspectors. I send you everything that you will need and support you. So a lot of people don't just know inspectors, right? But because I've been in this so long and I've made so many different, connections and relationships, I have different vendors that I connect with. So I make sure any of my inspectors, especially if I say, hey, I need this done. We have a really short option period. I will definitely send you over their list, and you just let them know that, you're one of my clients, and they will make sure they get out to take care of you rather quickly, because they understand the importance of getting this inspection done during the option period and still allowing the buyer time to review it in that time period, enough for us to create what's called a repair amendment and submit that repair amendment to the sellers. So what that will look like is you get your inspection report done. Inspection reports look very intimidating. They're not as intimidating as they look, but they look very intimidating. They're often like 30 to 40 pages. And in that 30 to 40 pages, a lot of times it looks like you just see pictures and a lot of words. And it's like, oh my God, is all of this stuff wrong with the home? And it's not necessarily that something is wrong, but it's the inspector's job to thoroughly inspect this home. So they're going to say, if a light switch isn't working, if there's a scratch in a door, a dent in a door, they're going to do a thorough examination of your home. And when they do that examination of your home, they produce a report. You and I, or you and the inspector, we can all go through that report and we determine what repairs we want to ask the seller for. And we can say, hey, Mr. Seller, we still want to buy your home, but we want you to fix these things first. So again, during the option period, so once the contract is executed, your option period starts. Your earnest money and option fee are delivered within 3 days. Your inspections take place immediately. We'll get that scheduled immediately once going under contract. And then we request repairs that may be needed as a result from the inspection report. All right, so what is a home inspection? A home inspection is examination of the condition and safety of a real estate property. So when these inspectors are inspecting your home, what they're doing, they're checking the roof. They will like get on top of the roof and walk the roof, take pictures. They're checking the exterior of the home. Do they see any unusual cracking? They're checking the AC, the plumbing, electrical systems, appliances, doors, windows, the complete interior. They have thermal imaging lights that make sure there are no leaks that are taking place in the home that maybe we don't know about. They're checking for the foundation, if there are basements, any crawl spaces, attic, ventilation, installation. They are checking literally everything, every square inch of this home, because they want to make sure that you are buying a home and you're 100% confident and comfortable in the purchase that you're making, and that they have educated you on everything that could be going on with this home. So that is what an inspection is. And again, a lot of people don't just know an inspector. So that's why, I always send over my database of inspectors who can inspect your home for you. If you have any questions about the inspection, just pop it in the chat or take yourself off mute. Or if you need me to recap at any point before moving forward, just feel free to take yourself off mute or pop your questions in the chat. All right. So after the inspection happens, it is possible that you want to ask the seller to complete a certain amount of repairs. And so, like I said before, you can say, hey, Mr. Seller, I want to buy your house, but I want you to fix these items first. And at that point, what happens is the seller can usually say, yes, okay, that's no problem. We'll go ahead and fix it. They can say, well, we live out of town, we don't have time. Can we give you the money and you get it fixed at a later date? Or they can simply say, no, we're not fixing it, right? So at that point, whatever they decide to do will let us know whether we want to move forward with the property or terminate. And also, as we go through the inspection report and you guys let me know some of the repairs, I also will inform you like what are very common repairs that are requested. So for example, we want to make sure that there are no large ticket items that, would be a problem when you move in. So we want to make sure there's nothing going on with the AC, the plumbing, there's nothing going on with the plumbing, the electrical, those things that will be a big ticket item, not necessarily things that are like, oh, this paint is chipped here, or maybe this doorknob is a slightly dented, not so much the smaller cosmetic things, but we want to make sure we focus primarily on those large, big ticket items that would be a major expense to you upon moving in the home. So, and at that point, again, we negotiate. They can say, yes, we'll fix it. No, we won't. We can give you money, but depending on what they decide, we have options as well. We can say, okay, we'll accept you not fixing it if you lower the sales price, or if you give us some money to contribute towards our closing costs. Or you can cancel. If you get an inspection report back that is so horrible, meaning like the AC is broken, the foundation is shifting, at that point, you can say, hey, Ashley, I do not feel comfortable moving forward with this. And it's as simple as sending a termination and release of earnest money. And at that point, we have terminated within our option period. You will be able to get your refund money, your earnest money refunded to you. And the only thing that you will have lost is the money that you paid for your inspection report and your option fee. So those are the two things that would not be refunded to you, because the inspection is not for the sellers. And it's also not mandatory when purchasing a home. However, it's highly recommended. And the reason it's highly recommended is because it helps you to make a sound decision on the purchase. So that's why you wouldn't get that money back, because that money was for the seller. I mean, that was for your protection. And then also the option fee, you wouldn't get that back, because again, remember, we paid the seller to have that option period. If you didn't pay for an option period, you would just go immediately into being under contract. And if you got an inspection, it would just be for your own knowledge. They would not be obliged to repair, replace, fix anything in your findings if you do not pay them for an option period. So after the option period expires, you may no longer terminate the contract without penalty using your option period. So if your option period expires on April 25th at 5 p.m., then if you message and try to cancel at 5:02 p.m., your earnest money is already gone because you defaulted on the specific time that was in the contract. I have never had a client lose earnest money because I try to get things wrapped up a day or two in advance before the option expires so that we don't have that time where we're feeling like, oh my God, we have to rush. This has to get done right now. We don't want to have that feeling. So I definitely make sure things are wrapped up as early in the option period as possible. After the option.
I'm sorry. I'm sorry. The option period is how long did you say? 3 or 5 days? How long is that?
It's typically 5 to 7 days. Some sellers have allowed 10 days. However, with the current market and how it is right now, 5 is pretty much a sweet spot. That makes them feel a little bit better having their home off the market 5 days versus 7 or 10 days.
Okay.
Thank you for asking that. Okay, so then again, after the option period expires, you can no longer terminate the contract without penalty using your option period. You're one step closer to purchasing your new home. Your survey will be ordered by the title company if the seller doesn't have an existing one, and the appraisal will be ordered by the lender. So again, I'm going to go into more details about this survey and appraisal, but this is just kind of a recap of what happens after that option period has expired. So basically, after we get out of the option period, there are several other things that are must happen in order for your loan to, to be fully processed, and several things that are required. So one of those is a survey, and the picture on the right is basically what a survey looks like. A survey costs typically between $400 and $600, and they're generally paid. They're ordered by the title company, but you don't pay for it until the end, and it's part of your closing costs. And so basically what the property surveys do is they're done to determine or confirm land boundaries. So basically it lets you, let's say a big storm came and it blew everybody's fences down and it was time to put everybody's fences back up. Well, you can hand your contractor this survey and say, well, these are my property boundaries. So, put this fence along my property boundaries because my survey specifies what is my property versus what is my neighbor's property. So if your neighbor put their fence too far over in your survey, they're into your land according to your survey, then they are obliged legally to take that down because they're on your property. So basically a survey says, this is my property, this is your property. It says if there are any easements in which you cannot build on, if there are any encroachments, meaning something else is legally having to stay onto your land. And then identify different things that also may be on your property. For those properties that may have a septic tank or a well, it also lays that out on there. So that will be part of your process. You don't have to know a surveyor. Literally what will happen is once we get out of the option period, the title company will start reaching out. And I always do Monday updates as well with the title company to make sure, if a survey needs to be ordered, it has been ordered so that we're not ready to close waiting on a survey to be ordered. But this is also part of your process and is typically part of your closing costs. And the title company orders it for you, and it's typically between $400 and $600. Also, an appraisal has to get ordered. So basically, the appraisal is done to make sure the property is really worth the price that you are paying. So an appraiser comes out, they use comparable sales to determine the value, meaning they're coming out to that house. They're going to look for homes maybe in that same subdivision or close to that same subdivision that is similar to the property that you're purchasing as it relates to like square footage, number of bedrooms, number of bathrooms, half baths, things like that, to make sure that the sales price is really worth the price. The literal definition of an appraisal is an opinion of value. So an appraiser is paid to give their professional opinion of value to determine whether a home is, really worth what you're paying for. The home will still need to appraise at or above sales price in order for the sale to go through if you're financing. So if you're financing and an appraisal comes in $5,000 under your contracted price, then that could potentially pose a problem. The seller, the financing, your loan officer, your lending team is only going to finance what the home is worth. So if you are having a home that's under contract for 205,000 and it only appraises for 200,000, we can go back to the home and say, hey, Mr. Seller, we still want to buy your home, but it was only worth 200,000. That's all we want to pay. The seller can say, no, I don't want to sell my home for that. I want 205,000. And at that point, you have the option of saying, okay, I will pay the additional $5,000 difference. Or you can say, well, I don't want to do that. I don't want to move forward. And you can terminate without penalty. There's a clause, especially for FHA and VA, and even conventional, there's a clause that basically says it has to appraise for a certain amount, or we can terminate due to financing. And so we would be able to terminate, and you would be able to get your earnest money back in that situation. But again, you would not get your inspection fee back, and you would not get your option fee back. The appraisal is typically paid at closing as part of your closing costs. However, some lenders require the appraisal fee in advance as part of an upfront closing cost. So it's still calculated into like the total estimated number that you will need. However, this would just be one fee that's paid before you get to the closing table. So that's why it's considered sometimes an upfront closing cost. And that's just a discussion that you have with your loan officer that you select. And Darryl will be able to provide more clarity on that shortly. After that, again, the title commitment will happen. So basically, what happens is the title company is the company. They are the people that will actually facilitate our closing, meaning when we submit your earnest money and option fee, it will go to the title company. The title company, on the day of closing, that's where we actually will go to the title company. So their job right now, especially once they receive our contract, is basically doing a title commitment, a title search. And so what will happen is the title, 1 or 2 weeks after the contract is received by and receipted by the title company, meaning they confirm that they have it in their possession, is the title company will mail or email, most likely email, that's just where we are in 2022, email you the title commitment. And there is a section on there called Schedule C that we will all look at carefully together to see if there are any problems that have to be addressed before we get to the closing table. And so some examples of that can be like mechanic liens on the seller's property, pass through homeowner fees. Maybe that person never paid their homeowner association dues. So before they can sell, or part of their proceeds have to go to the homeowners association to take care of that. If there are any legal issues, or, divorce or marital status issues, that will all be on that Schedule C. Just so that we know in advance, this could potentially be a problem that may delay our closing date. However, it doesn't always happen, but that's the title company's job. They want to make sure that this title of your home is free and clear, meaning that every time this property was bought and sold by someone, it was done with the proper paperwork, so that 5 years down the line, someone can't knock on your door and say, hey, Tanae, this was my dad's house and he never got the proper paperwork to sell it to you properly. So really, now that he's gone, this is my house. So the title company makes sure that no one else can basically claim this home, and that every time it was bought and sold, they have the paperwork to prove it, so that everything is legitimate and the ownership is 100% yours. Nobody else can claim rights to that. After that, towards the end of the process, your loan officer will basically send you what's called like a HUD-1 settlement statement. And basically this contains all of the charges associated to you buying your home, as well as any credits that you get from the seller. And then basically the net amount, the net number is the amount for the cashier's check that you will bring to closing, or the wire that you will send to the title company. So basically on this, your loan officer will send this to you about the week before closing, in that week. And it will literally break down line by line, dollar by dollar, where everything is going. Every single penny that was a part of this transaction, for your loan process especially, will be accounted for on that document. So you'll see this document before you get to closing, and then you'll also see a copy of this document at closing, and we will go through it with the title company as well. And the reason, like, you usually get it beforehand, because let's say people make mistakes. People are human, mistakes can get made. So let's say, there was a fee, they didn't credit your option fee back to you. Then on that settlement statement, we will see that and we can say, hey, this is wrong. Our option fee wasn't credited to us, or we don't see our earnest money being credited to us. Those types of things we can see. And the sooner we get it, the better, so that we can have ample time to review it, go through it, and make sure that everyone understands it. And at that point, we are closer to closing and funding. So basically, on the closing day, you will bring your cashier's check. And again, on that document that they send, your lender will have given you the amount to bring, and your driver's license that's not expired. Expect closing to last about an hour. It could be a little longer, but that's about on average. Expect it to last for about an hour. And be flexible about your closing time, and don't schedule anything else on the dates of closing in case the times change or the paperwork is delayed. As often as we try really hard to stick to the dates in the contract, sometimes things happen. And by things happening, it can mean the appraisal was delayed and the appraisal report was delayed and getting back to the loan officer. So now the closing date has changed a little bit. So I know a lot of people try to schedule their movers to come on the closing date. But if something happens and your closing date changes by a day or 2 days or 3 days, then it's like you have to keep calling the movers to say, oh, I'm sorry, just kidding, come tomorrow. Okay, I'm kidding, just come the next day. So being really flexible about that closing date and time. So try not to have anything else scheduled, especially, there have been instances, they're not the most ideal instances, but there have been instances where, maybe we were supposed to close at 10, but there was a slight delay in getting some paperwork to the title company. So we may have to close at 1 or 2, so just be flexible about that day in the event that, the times change, something happens, things happen. Everything won't always be perfect. It's not that it's a negative thing, but sometimes things just happen. And so we want to make sure we're flexible about our closing date on that day. So just try not to have anything else scheduled. Ideally, we want to try to close the home before 2 p.m. so that funding will happen on the same day. And if funding happens on that same day, then you can get your keys that same day, and all will be well. And funding basically means that the sellers get their proceeds. The loan is in place and you're able to obtain possession of the home according to the terms in the contract. So once they got their money, the title company and the loan officer will send an email saying, congratulations on your home, we funded. That means at that point, you can now get the keys in your hand and you can walk into that home and it is yours. What happens sometimes if you have a really late closing in the day, it doesn't fund the same day. And if it doesn't fund the same day, then you can't have your keys the same day. So that's why scheduling as early as possible is perfect. And also that's why we say, try not to schedule the movers on the same day in the event something happens. So if it doesn't fund, maybe somebody needs to re-sign a document, you won't be so thrown off for having to pay extra fees to change the date for your movers. Okay, so I know that many people have been, hearing that right now it's a seller's market, and it is. However, there are different strategies that you can do to basically make sure or to try to help get your offer accepted. So for me, I always call the listing agent in advance. Before I, actually, let me pause. Does anybody have any questions before I move into this section about anything? Does anybody want me to pause, clarify something? If you do, feel free to take yourself off mute or drop it in the chat.
You're doing a great job, by the way.
Thank you. Thank you.
Yeah, I know I'm okay. I can't speak for everyone, but so far I'm okay. So yeah, you are doing a great job, as Darryl said.
Thank you. Thank you.
You're welcome.
Okay, so basically, we know that is actually, I'm gonna come here and then I'll go back. So basically right now, if we have to do an overview of the current market, The current market is a seller's market and there's low inventory. What that means is it's like a game of musical chairs. You know, in musical chairs, it's not enough chairs for everyone to get a chair of everyone that's playing a game. So right now, that's kind of what the housing market looks like. It's low inventory, but that doesn't mean that now is not the time to purchase a home. What that means for buyers is that homes sell faster and buyers are often competing with each other to get a property. It means that a lot of times buyers are not getting closing costs when it comes to like resale homes. Now, new construction, they often have different set of incentives, but for resale homes, it's not. So what happens is a lot of buyers hear stories from when their friends or family members bought homes years ago, 5 years ago, 10 years ago, even 4 years ago, when the market was very different. And they say, oh, my seller paid all of my closing costs. You should ask your seller to do the same. However, that advice is not current for today's market because today's market is very competitive and sellers have options. So if they get two offers, one offer is the sellers don't have to pay for anything. And the other offer, the buyer is asking for $5,000 in closing costs. Well, naturally, they're going to go with the offer where they don't have to pay for anything because they're probably going to profit more. So, you know, just being really strategic when you submit your offers and always submitting your highest and best. So what, you know, some TV shows on like HGTV and things like that, what they've done is made it seem like all sellers, they have to negotiate back and forth. And that's not the case. Because as I stated in the beginning, once you submit an offer, a seller has three options. They can accept it, meaning they love everything about your offer. They can reject it, meaning they hate your offer, they're offended and they don't have to respond. Or they can counter offer, meaning they can say, well, I like some of the terms in your offer, but not all of them. Let's see if we can work to come to a common ground. So if a house is priced at 250 in today's market, especially if you put an offer in for 200,000, a lot of times the seller may simply just say, we reject your offer. They don't have to counter. They don't even have to take your offer into consideration at any given point in the future. So that's something to take into consideration and, you know, to remember that while we're in this market, always submit your highest and best because there may not be the opportunity for you to submit another offer. So always submit your highest and best offer. And all you can do is what you can do. You know, if you can't afford to go up any higher, then that's that. It means that sellers are at an advantage, and it means that you need to have your pre-approval ready to go before viewing any homes. So if you have one person who doesn't have a pre-approval and they're kind of just shopping around aimlessly, and you have another person that does have their pre-approval, you'll both fall in love with the same home, both are ready to put in offers. Well, if you don't have your pre-approval already, you still have a whole process. You still got to complete a loan application, submit all your documents to a loan officer. And then if they need any additional information from maybe an employer, a verification letter, you still have quite some time before that will get issued to you. So whereas the person that has their pre-approval letter in hand, they can say, here's my pre-approval letter, here's my this, it says my loan officer has already verified my credit score, verified my funds, verified everything you need to do. Here are the term conditions, here's everything, here's my whole offer. Whereas the other person, you don't even have a fighting chance because by the time you get all of that information, the home may already be under contract. So that's why it's important to already make sure you have everything ready to go, because right now the market is so competitive. If you don't have a pre-approval and you're shopping for homes, you've fallen in love, then all you did was just fall in love with a home that you really probably don't even have the opportunity to put an offer in for. So did you say something, Darryl? I'm sorry.
No, I did not.
Oh, okay, I'm sorry. I thought it popped up. But yeah, so that's what that means. So basically, you want to make sure that you are ready to go before you start viewing homes. And so basically, knowing that the market is competitive. So there are some strategies that we can, put forward to getting your offer accepted. So one, having your realtor, aka me, I called the loan officer. I called the listing agent to ask if there's anything in particular that the homeowner is looking for. For example, do they need a free lease back? Meaning that a lot of times when sellers are selling their home, they're probably transitioning into another home. And so what that lease back would allow them to do, it'll allow them to close on the home that we're under contract with. They will get their proceeds for that home, but they will lease the home back from you for a few days until they close on their next home. So you become the landlord and they become the tenant just for a few days. And a lot of times for sellers, a free lease back is very lucrative for them, because that means that they're not paying any additional money to stay in the home after our closing. Sometimes they need an extended closing date because maybe they're trying to line it up to when maybe their home is being built and they're trying to line it up to a time in which that home will be complete. Or maybe they need a rush closing date. So I know that Darryl and his team are good at closing loans fast, especially pending you guys have all of your information to him before you even, go out to look at homes. So that's something he'll discuss as well. Other strategies include putting down like a larger earnest money and or down payment. So the larger earnest money amount is basically telling the seller that you're putting more skin in the game. You're serious. I'm serious. I'm putting more than 1% down. I'm putting a little more skin in the game, even though that still doesn't change the amount of money they're going to be getting, but it shows them that you're a little more serious. And even when you put down a larger down payment, again, the numbers don't change for them, but it shows them that money should not be a problem. This deal, the reason this deal is not going to close is not going to be because they don't have all of their closing funds. Not asking for closing costs. That's kind of where we're at right now. I'm not going to say 100% of deals don't get closing costs, but I haven't had it happen in quite some time just because of where we are with the market. Also doing full or partial appraisal waivers. So I know a lot of people have been hearing people say they're waiving the appraisal or there's an appraisal gap coverage. There's full or partial waivers. Some people will waive the appraisal completely. That means if the house comes in if you're under contract for $250,000 and the appraisal only comes back for $200,000, you are telling the seller, I don't care what this house comes in at, I will pay the difference between the appraisal price and the contract price. That's a full waiver. Very risky, extremely risky, but it's being done in today's market. Another option is partial waivers. So you can tell the seller, for instance, I have a client right now, they're purchasing a home. The home was on the market for about $637,000. They put an offer in for $655,000. However, they told the seller, we are willing to waive the appraisal by $50,000. Meaning they told that seller and the owners and the listing agent that if the home doesn't come in under $605,000, we will cover the additional $50,000 if there is a shortage. If there is that gap, we will cover anything as long as it doesn't come in under $605,000, because they only wanted to waive the appraisal for $50,000. You don't have to do those such large gaps, but a lot of times right now, sellers want what's guaranteed. So for instance, I was talking to this listing agent and he said, we had someone put in an offer for $700,000. He was like, but I know this home isn't going to make it not appraised for $700,000. So a $700,000 offer doesn't make sense. We want to go with what's guaranteed to us. What amount are we guaranteed to get? Because that person put an offer in for $700,000, but they didn't give any type of partial appraisal waiver. So it's not always the highest number that gets selected on the offer, the highest offer amount. It's what is the most guaranteed to the seller. That's what they're looking for. Short option periods are more, incentive is a better incentive for getting your offer selected by a seller, and removing as many contingency as possible. So for example, if you have a house to sell, you have to sell that house before you can buy it, that's a contingency. So that's something that the seller may look and say, like, well, they can't purchase my home. They can only buy, the purchase of my home is contingent upon them selling their home, or contingent upon this happening. So removing as many contingencies as possible. Again, they still accept offers that go under contingency, especially if it's a really good offer. But, you know, if there are any other contingencies, so such as the financing period, maybe making it a shorter financing period, but making it as most lucrative and cutting down time as much as we possibly can. Paying for the title policy, using a reputable mortgage lender. This is, I mean, this, you have no idea how many times, like, you know, it's certain lenders or large companies out there that if I get that appraisal, I mean, if I get that pre-approval as a listing agent, I'm not even going to take it into consideration, because I know that this company is known for doing a bad job and not doing a good job in pre-qualifying their customers up front, often resulting in this person not closing. So sometimes if you submit a really good offer, but the listing agent doesn't like the loan officer, they'll say, we'll accept it if you change your loan officer, because we know that person does a bad job. So that can happen. That's why choosing a reputable mortgage lender is really good. And then just being flexible. If they say they want to close on a different date than you have on the paper and you can close on that date, hey, be flexible. That is also what is another strategy to helping get your offer accepted. I know a lot of times, also some loan officers will call or write a letter on your behalf just saying, hey, this person has been pre-underwritten. There is nothing that can cause this, you know, to fall through. We are very strong, confident this is a strong buyer, you know, speaking really good on your behalf, and also showing how accessible they are if the listing agent has questions in the meantime. And yeah, these are all really good just strategies. It's not saying that if we do every single one that it will get accepted, but these are all good things to do it, and it'll at least give us a fighting chance. And then preparing for home ownership, it's a really big decision, right? And so a lot of times people don't know their number. When you start getting in the loan application process and the pre-approval process, your loan officer is going to say, hey, you know, how much are you trying to qualify for? How much do you want to spend on your mortgage per month? And you have to know your numbers. You have to know how much you feel comfortable spending. You have to already determine how much you can afford to spend monthly, meaning you need to have already done your budget, right? You need to make sure you've already written out your budget. And if you're paying $1,000 for your mortgage, for your rent right now, and you say you can afford to spend $2,000 on your mortgage, then that means you have done your budget and you see that $2,000 still allows you to have that same quality of life you did previously to get in a mortgage. So what I always suggest, like before I purchased my home, this is what I did. So if my mortgage, if my rent was, I'm just going to use random numbers. If my rent was $500 and I knew I was about to get $1,000 mortgage, I would set an extra $500 to the side, you know, because that would total what I'm saying I could now afford as a mortgage, and put that aside for a few months to see, are you still able to maintain your regular quality of life with that mortgage increase to your budget? Because a lot of times we can say a number, but if we don't practice it in action and see if we can really afford that number consistently on a month-to-month basis without feeling like you can't even go get a cup of Starbucks, then maybe that number is not right for you and you need to adjust that number slightly. So I have a free download. If you go to my Instagram page, this is my Instagram name, at Ashley Spates Realty Group TX. Click the link in my bio and download what's called the Pre-Home Buyer Readiness Guide. In that guide, it's going to walk you through what to expect through your process of before you even start speaking with the loan officer, what to expect just throughout that whole process, and practical suggestions on how to get ready. And also there's a budget sheet so that you can start practicing your budget and really knowing your numbers so that you're really prepared when you start your home buying process and you feel comfortable with the number that you give your loan officer, and not one of those situations where you want to terminate in your option period because you realize that maybe that number is much, it's too much. It's too much for your budget. So another thing that I do, or I encourage my clients to do, is to, before you go look at that home, you know, you say, hey, Ashley, I want to go look at these 3 homes on Saturday. And I'll say, okay, hey, Darryl, can you give us the numbers for these 3 homes? And by giving us the numbers, Darryl will tell us, okay, based on this property address 1, you're looking at a monthly payment of approximately this amount. And you're looking at a total cash to close amount, inclusive of like your down payment, closing costs of this amount, so that you know that home is an affordable price point for you. Because you can have 2 homes, the same price, both fall within your pre-approval amount, but one have higher taxes, therefore raising your monthly payment. So that's why I always, before we go out, I don't want you to fall in love with something that you can't afford, because that's not fair. Like, I wouldn't want anyone to do that to me. So of course I treat your process like how I would want to be treated, if not better. And we get those numbers so that there's no way you can come into this process and say, or get into a home or go under contract and be like, oh my God, I don't have enough closing costs. Oh my God, I can't afford that monthly payment that's higher than I thought. Oh my God, oh my God. I get those numbers because we want to make sure that you are set up for success. So again, if you go to my Instagram page, as at Ashley Spates Realty Group TX, click the link in my bio, download the pre-home buyer readiness guide. It has a budget sheet in there, and it also has practical suggestions, frequently asked questions, advice for this home buying process, even before you may even connect with the loan officer. So that was my spiel. I will go ahead and Darryl, are you ready to take over? Or first, I'll start this and say, does anybody have any questions about that section thus far that you want me to revisit, say again, reiterate? If you do, just take yourself off mute and I can go ahead and answer any questions that you have.
Yes, I have a question, Miss Ashley.
Yes, ma'am.
First, I'm so excited that I joined in. I'm actually learning a lot.
Yay!
So, I did also want to ask, because of I see so many like hard deadlines and time frames. With me, my situation is that I'm renting, of course, or like you said, taxes go up. I'm renting a home. Then they increased again $125 on my rent. So now I'm like, okay, that's it. I got to get out of here. And I'm paying too much on my own stuff. But what is the time frame that you will give? Because now, since I did re-sign with them because it was such short notice, by next April, I think April or May, somewhere up in there, I will need to be out. So what would be a good time frame for me to even start the process, since there's so many like short deadlines with like the option period and et cetera?
Yeah, for sure. So for one, I always encourage people to connect with Darryl at least like 6 months in advance. The reason I say 6 months is because if indeed we need time to work on your credit, we have that time, and we don't find out in March, that now you got, it's going to take some time to work on your credit. And then now you have to rent for a whole nother year. So I always encourage people to get with Darryl 6 months in advance, so you can also have an idea of how much home you want to buy or that you will be approved for. And so you already have a savings plan in place as well. And that's what I would say, especially if it comes to a situation where you may need to get a home built. So what's happening right now is, even with new construction, is not a lot of inventory. So we may go there and they may have the lots available, but it may take 6 months to get that home built. So if you started your process early, we can already go under contract, and then we can have a smooth transition into 6 months before, and transition to your lease ending and being able to have enough time to move out of your home and into your next home. But Darryl, did you want to maybe answer that question as well? What timeline do you prefer people to reach out to you before getting that pre-approval, or I guess to start that process?
Can you hear me?
Yep.
Incredible job, by the way. That was really good. A lot of good information. It's never too early. I always tell people it's never too early I don't care if you're a year out. The thing with me is like, I'm always available to take a look at your situation once you submit that application. And then we could just see where you are, and you can put that strategy together, whether you need to save up some more money, work on credit, or whatever you do. So even if you're a year out, go ahead and put it in. If you have it on your mind, it's something that you're passionate about, go ahead and put that application. So whether it's a year, 6 months, 3 months, if you're ready right now, all of it, all of the above, let's do it. Let's put that application in. So for sure. Okay. Well, good deal. Well, I guess I'll go ahead and take over from here. Super excited. Thank you so much, Ashley, for that. I do appreciate it. I do appreciate you having me here today to be able to share. I just wanted to give you kudos. So one of the things I did want to say, all real estate agents are not created equally. So if you definitely want, especially with as competitive as the market is, you want someone like Ashley that's on your side, that's going to do all the right things, that's going to make your offer competitive to help get your offer accepted and get you the best deal possible. So people ask me all the time, well, do I start with the lender or do I start with the real estate agent? So you definitely want to start with your real estate agent, because she's going to have multiple relationships with lenders like me or different lenders. And so based on your particular, what your situation is, what you make, people need to have different needs. She'll partner you up with the right lender and get you going in the right direction. So I can't stress it enough. I know a lot of us are cousins and everybody else, real estate agents, haven't really been doing it. She does this full time, eats, sleeps, and breathes this stuff. So you definitely want to get with Ashley. She's the best in the business. So I couldn't start off without saying that. So I'm excited. I'm not going to take up too much of your time. I want to come on. So first of all, my name is Darryl. I am a loan officer with Cherry Creek Mortgage. People like Cherry. So Cherry Creek, we're based out of our corporate offices in Denver. I'm here. We have maybe about 4 branches here in Houston. I'm in Kingwood right now at our office. We got another one in the Woodlands, and we have 2 on the west side in the Lands out that way. So, but we're all across the country. Matter of fact, last month was our 35th year anniversary of being in business. We've helped over 300,000 families, approaching close to $80 billion in mortgages. So we're super passionate about what we do, super excited about what we do. And so I want to start off with that. So with me, a little bit about my background. I've been in the business for about 14 years now. Started off as a real estate agent, real estate broker, and then now I've been on the mortgage side for about 6 years. So I don't know it all, but I know quite a bit about this business. And so super excited to be here and partnered up with Ashley and doing this. So my job today is on the financing side. So she gave you a lot of good information. So on the financing side is just to give you that confidence, just to give you the meat. Okay, what is it that lenders are going to look for? So you'll be aware, okay, what does my credit need to look like? Assets, what are some of the documents? We're even going to touch on debt to income ratio, a little bit on loan programs. So just, some of the main stuff. And so like Ashley was mentioning, you can wait to the end where we'll take some questions, but if if the spirit moves you, go ahead and jump in and go ahead and ask some of your questions that you have. So I'll go ahead and jump in. So the 4 C's of credit. So when you go into that, whether it's, a lot of times they don't come in now, we just call and send an application and do online. But once you do that application, and somebody chime in. So when you put in an application, what do you think is the first thing that lenders look at? Anybody?
I'll say credit.
Boom. Credit. One of my boss, we go back and forth about it because they say income. It's like income. I mean, income is nice, but if your credit's not right, that's the first thing I want to look. I don't care how much money you got, how much money you make. If your credit is not up to par, it's stop, don't pass go. And so that's 4 C's: capacity, capital, credit, character, and collateral. So it's that character, your history of delivering on your commitments. I always tell people, so we think about your family member, right? Your family member, they ask you for $100, $500. We know they auntie, their mom, that might be your auntie. We know where they stay. We've known them for years. And sometimes we have a hard time loaning them $100. So just imagine the bank doesn't know you, right? And you're asking them for hundreds of thousands of dollars, $200,000, $300,000. What I like to say, I'll say, print out your credit report, look at your credit report and act like you're the lender. Looking at that credit report, would you loan you $300,000? by looking at that credit report. So I want you to think about that for a while. So typically lenders, we go back 24 to 36 months on that credit report. And so I can't stress it enough. It's the easiest way to get you approved and the quickest way to get you denied typically. So what we do is a tri-merge. We pull from all three credit bureaus, Equifax, TransUnion, and Experian, and wherever that middle score falls numerically, that's the credit score that we're going to go with. And most loan programs, which we'll touch on here in a minute, they want to see that middle score is a 620 conventional, middle score is 620, and then FHA, that middle score is 620. But FHA they have a little bit more flexibility, case by case basis. They'll go as low as a 580 credit score. But you want to ideally, you want to have your score above 700. Ideally, you want to, especially if you get it over 740, that's where you want to have your credit score. And so, yeah, 24 to 36 months, you got to be careful with those late payments, those charge-offs, and those collections. Conventional is, even if with conventional, it's a little bit harder to get approved for with FHA. And then even with FHA, if you do have some collections that are over $2,000 collectively, then we even have to calculate 5% of the balance and add it to your debt to income ratio, which we'll talk about here in a second. So I just can't talk about it enough. Please, please, please be careful with your credit. Another thing about credit and debt, don't pay anything off right now. So a lot of people say, well, I want to wait. I want to pay this off. I want to pay this down. I get it. It makes sense, right? Because you want to, with that, with the debt to income ratio, which we're going to talk about here in a minute, you want to pay down. So the less debt you have, the more you can get approved for it. That is true. But you want to get with the lender, preferably me, first before you do that. Because what will happen is I can look at your situation, right? I can look at your full profile. And one, you may be able to get approved for the amount that you wanted to without paying off some of that stuff. Right. And so now you're paying, and if you went ahead and paid off some stuff already, so now you would have paid off some of that stuff and you didn't need to. That could have been some of your money to go towards your down payment or closing costs. So you're paying off some stuff unnecessarily. Or let's say if you did need to pay off some stuff, well, at least now I can say, okay, or let's say our approval amount is 200, you're trying to get to 250. Well, then I can look at it and say, okay, if you pay this off exactly and this off, then it'll get us, we're good to go. And then you wouldn't even have to pay it off right at that time. I could still give you the pre-approval. You can go get under contract. We can go into underwriting at the beginning. We wouldn't have to show proof that those items were paid off until we get to the end of the process when we submit for final approval. So it's very important. Don't, try not to, if you have some stuff, you just got to do it. But try not to, you may be spending money unnecessarily. Go ahead and get with a professional so they can take a look at your situation. So just be careful with that. If you have some items like bankruptcies, been seeing some of that as of late, Chapter 13, there is a waiting period. Doesn't mean, especially if your scores are above those 620 and getting higher, you could possibly still get approved. There are some waiting periods if you have a Chapter 13. It's better if you have a discharge date. If it's a discharge date, it's 1 year on FHA. If you have a dismissal date, then it is 3 years. That dismissal date just means you didn't follow through with your agreement. And if you have a Chapter 7, it's 2 to 4 years with that. So it doesn't mean you're completely out. And the same thing goes for foreclosure. Just depends on the program. The main thing, if you have some of those major life occurrences, just work on getting yourself reestablished, getting those scores up, and touch bases with women. We can see where you're at in those timelines and put a plan together. So can't say it enough. Credit, be very, very careful with that credit. So, and then also, so next, what we look at is the money, right? Your capacity, your present and future ability to meet your payment obligations. So one of the things we ask for, I want to see your pay stubs. I ask for 30 days of pay stubs. So the pay stubs, people ask, oh, well, I get direct deposit. Is that okay? So no, we need the actual printouts, last 30 days, we need the printouts so we can see if there's any deductions. Let's say, well, you're going to have deductions, but we want to see if you have any type of garnishments. You have some IRS garnishments, so you have child support or alimony, you have those type of things, then we're going to deduct that from your income. And so while we're looking at the income, we're going to use your gross income, right? So if you don't, just try to get a rough idea. We're going to go over the debt to income ratio. We're going to use your gross. So if you have an idea of what you made annually last year, you can use that. If you're self-employed, so it's a little different. I do run into issues with my self-employed borrowers a lot. You have to be careful with those deductions. So when you're self-employed, we want a 2-year history. And so we want to see those tax returns for the last 2 years. We want to see those tax returns for the last 2 years. And so we're going to average out the income that's left over after deductions, right? So what happens a lot of times when someone made 150,000, but then they wrote off 120. So now you're only left with $30,000. So now I'm going to approve you based off of $30,000. So just be super, super careful if you are self-employed with those tax returns. So, and then back on the other side, if you're a W-2 employee, if you do jump around, so, you know, it's best they're looking for that consistency. If you have, we go back 2 years, we need a 2-year history, whether it's self-employed or if you're a W-2 employee. Best case scenario is if you've been working with the same company. That's what they like to see. The longer, the better. That's stability, right? They're looking at, hey, are you going to be able to repay this debt? But if you have moved around, let's say if you just moved around, like you could have moved last month, that's fine. We can still make that work. We just have to paint that picture for the underwriting. Why did you move? Did you upgrade? You get a better job? Or did you laterally move? You just went to another company, same industry, that's good. Or if you went to another industry, is it for more pay? So whatever it is, we just have to, you know, paint that picture. Or let's say if you've done multiple jobs within the last 2 years, then we just have to tell why. So, and there has been cases, we have some nurses or different people who move around a lot. That's fine. It takes a little longer. We have to get all those verifications of employment and look at the trend of the income, but we can still make it work. So that's a common question that I get. Hey, if I just move, I've had instances where, especially if you have that consistent history, we've approved people off of expected income. They were getting a new job and all we had was an offer letter. We'll approve it as long as that income is going to start within 60 days of the closing date. A lot of times we can make that happen. So, yeah, so it's definitely a lot of flexibility. Not I won't say a lot, but there's some flexibility with getting some of that stuff done. So we just have to paint that picture. And then lastly, I'll talk about, so with W-2 and 1099, we see this quite often. So if you're W-2, if you go from 1099, we look at 1099 or independent contractors the same as we look at self-employed. So if you are 1099, we're not going to go off those. We're going to need those same way as self-employed. We're going to need those tax returns. We're going to be averaging your income after deductions. If you go from 1099 to W-2, you won't have to wait the 2 years, especially if it's in the same industry. They look at W-2 income is more stable. So it's easier to get approved that way. If it's the opposite way, even if it's in the same industry, you go from W-2 to 1099. Now they're looking at you just started a new business and you're going to have to wait those 2 years. Very rarely, if you go from W-2 to 1099 and it's in the same industry, we can possibly get something done within a year once you file those tax returns that first time and there's a consistency. And so, so we could possibly go that way. So just be careful with, if you're thinking about going from W-2 to 1099, just be aware of stuff like that. So that's that. And then with overtime income or bonuses, they want to typically 1 year, but they typically like to see 2 years, because what we're going to do. So I just had one situation where I was like, okay, you've been at your job more than 2 years, go ahead and send me your very last pay stub from 2021, 2020. So how we come up with the qualifying income that we can use, we use that base income, and then I'm going to average out your last 2 years, whether it's, so let's say it's just overtime, your last 2 years of overtime with your year-to-date overtime, and we're going to average it out. They want to see that consistency. If the overtime is less, it's trending down, then we may not be able to use it. So yeah, so that's what that. So you'll have to give extra documentation for that, but we can use that. Capital, so assets. So sometimes people don't want to. They don't want to give you their bank statements. I need your last 60 days. I need your last 60 days of bank statements. I'm not. I don't care what you spend. I'm not in your business. I don't care what you spending your money on. One, lenders, they just want to see, one, you have enough money that you're going to be able to pay your mortgage, right? But then also they want to see that you have enough for your down payment and closing costs. So down payment, we'll talk about programs here shortly. Down payment is going to be either 3.5% for FHA or 3% first time home buyer with conventional, as long as you haven't owned a home in the past 3 years. So, and then you have, so any loan program I want you to think about, you have down payment and you have closing costs, okay? So rough estimate, people say, okay, well, rough estimate, how much is it? Rule of thumb, I tell people, whatever the sales price is, 6% of that. That's a good estimate of what your estimated cash to close is going to be. And then they have different options out there with down payment assistance and stuff like that. So they're looking at those bank statements. They want to see that you have enough money for that down payment and closing costs. Also, they're looking for any large deposits, right? So any large deposit is anything over, let's say, depends. It's at the underwriter's discretion. It could be anything over 1% of the sales price or anything over 50% of your gross monthly income. So if there's any large deposits within those last 60 days, that's what they want, the last 2 months of bank statements. If the money is already in there within those last 60 days, they're not going to ask you about it. They don't care. They call it seasoned money. They don't care where it came from. But within those 60 days, if you do have large deposits, you will have to source it. Just mean a paper trail. They want to know, where did it come from? If it's a large deposit, and you will have to tell where those funds came from. But they look at that. So with the debt to income ratio, if you did have a large deposit, let's say you've been approved for a certain amount, we're right at your maximum debt to income ratio. If there is a large deposit and you just got it, it could have possibly been from another bank, a personal loan or something like that, that may not have hit your credit report yet. And so your debt to income ratio may not be accurate. And so that's why they kind of ask a lot of questions about large deposits and stuff like that. And so, but you can get a gift. We just have to source it depending on the program. With conventional, it typically has to be from a spouse or like a fiance or a relative. They can give you a gift. They just have to sign a letter and say that you don't have to pay this money back and you can get that gift. And then FHA has a little bit more flexibility. You can get it from a friend along with family members. So you can get that gift. And another thing that they look for is insufficient funds on those statements. So you definitely know within those last 60 days, you don't want your account going into the negative, right? Underwriters look at that the same way that they look at collections. They're going to want you to send a letter. They're going to want you to type up a letter on a Word document and explain to us, why is your account going into the negative? Because they're like, okay, if you're having issues now, are you going to be having issues with paying this mortgage? So those last 2 months of bank statements, be very, very careful not to have any of those negative going into negative. And so
1 second, Darryl. I know while you were on bank statement, someone asked a question and said, bank accounts, would Chime Bank or things like that be counted as an actual bank?
Chime, I'm not familiar with Chime. Is that like Zelle or something? What is Chime?
You want to unmute Shamika so we can get some clarity on that question for you?
Yes, Chime's more like Zelle. The only thing is with the Chime Bank, you can have a credit card. I have a credit card with them, but you can't like get a loan from them.
Are you able to like print out statements?
Yeah, you can print out statements and everything. You can move money just like a traditional bank. The only difference is that you can't like get a mortgage loan from them or a car loan.
No, that's fine. As long as you're able to send those most recent statements, has your name, account number on it, that's fine.
Okay.
Mm-hmm.
And Shamika, your next question that you asked, he's gonna get into that in his next segment. So if you still feel like you want more clarity after this next segment, then we'll double back down on that. Is that okay?
Yes, that's fine.
Okay.
Okay. And then lastly, about assets, what I was going to say is the more assets you have. So even if, let's say, you have other accounts, other bank accounts that you're not going to use in your in the transaction, go ahead and submit them. If you have investment accounts, 401k accounts, stocks, bonds, any assets that you have, go ahead and submit those, even if we're not going to use them in the transaction. One, it helps with, because what we do is once we have your full profile, we're going to run it through the desktop underwriting, and then it gives the approval, and it takes all that, your debt to income ratio, but also how your assets that you have, the amount of assets that you have, it takes all of that into consideration. And on top of that, when the underwriter is making that final decision, like, we know life happens, but it makes them feel warm and fuzzy when they see you have extra resources to pull from, even if you need to. So the more assets, the better. So if the loan officer's asking you for these additional items, go ahead and send it to them, even if you're not going to use it in the transaction. And then lastly, collateral, which Ashley was talking about, those appraisals, very important. So on that, the collateral for the loan is going to be that property. The bank is going to put a lien on that property. And once the loan is paid off, then that lien will do a release of lien, and the lien will come off that property. And so that appraisal is so very important. You know, if it comes back, if the appraisal comes back short, we stop everything. Like that's a showstopper right there. If it doesn't come back, because the bank, they're not going to loan more than what the home is worth. And so that difference, like you said, 200 to 205, that additional, because we already talked about, let's say 200,000 times 6%. So that's already 12 or so thousand just for down payment and closing costs. Now we're talking about additional 5,000 on top of that. Somebody's got to pay that difference. So either it's going to be the seller, which a lot of times they don't. I know you as the buyer, a lot of times you don't. When it's that close, when we've seen it that close, typically what we'll see happen, if each parties really want to close, they might negotiate and meet in the middle. They'll come down 2,500, the borrower come up 2,500. Or sometimes people don't want to budge, and it could be a deal killer. Like, it can stop everything at that time. There's also an additional step where you can appeal. Well, the seller can appeal the appraisal. Yeah. So, but so in my situation, you're my client. So I would still have to get your approval, because that's your appraisal. You pay for that appraisal. I would still have to get your approval to let them appeal the appraisal. And how that works is they would have to submit some additional comparable properties that were not included on that appraisal and write why they think the appraisal was wrong. And so they submit that, and then we submit it to the appraisal department. And then typically they're going to be like, nah, this is what they do. Like, you tell them, this is what I do for a living. You try to tell me what the value is. But every once in a while, I have seen the appraisal, it gets adjusted a little bit and it goes up. So, but that collateral, that appraisal part of the process is very, very, very important. And so just some required documents. You want to start getting those documents together. 2 months of recent bank statements we just talked about, any additional assets that you have, most recent 30 days of pay stubs, those printouts. If you know you're trying to use overtime or bonuses, go ahead and request that, just that one very last pay stub from 2020, 2021. Loan officer will love you for that. Like, oh man, you're super prepared. It'll help them give you that approval much faster. And then the last 2 years of W-2s, and be thorough when you're filling out that application. If you know you've jumped around a little bit in the job, just be thorough when putting and it doesn't have to be exact, just a rough estimate of your start and finish dates of the different jobs that you've worked at. And then also your tax returns, you want to give those most recent 2 years of your tax return. So right now, the tax deadline passed. So what'll happen right now, let's say you haven't filed 2021 yet, go ahead and submit 2019 and 2020, and you'll have to show that extension for 2021 now on those tax returns. So those are just a few documents. So I know some of you guys are on your phone, but for those of you who may have a pen and a piece of paper, I want to go over debt to income ratios, like a quick exercise right here. So what the debt to income ratio is, so the main two programs are FHA and Conventional, which we'll talk here in a slide or two. The maximum debt to income ratio was put into place so that you would stay in your home. What we do with the debt to income ratio, so for example, for a conventional loan, the maximum debt to income ratio is 50%. So what that means is what we do is we take on your credit report, when we pull your credit, we're looking at the active debt that you're making payments on that show up on your credit report, right? So we don't really care about the balances. We care about that monthly payment. So we're going to add all that up, take that total number, add it to the mortgage payment that you're trying to get approved for. That debt plus the mortgage can't take up more than, for conventional, 50% of your gross monthly income, right? Same thing if you're self-employed. When we average it out, we're going to come up with that monthly income. That debt plus the mortgage can't take up more than less than half of your gross monthly income. We understand that when we pull your credit report, that's not all of your debts, right? Because it doesn't calculate your rent. It doesn't calculate your utilities or your car phone. It's only the things that will show up on your credit report. So we understand that that's not all of your debt, but it gives us a good idea of what some of your liabilities are, so what some of your payments are. So we want to just go through this real quick. And this is so if the debt to income ratio is too high for the approval, then we have to figure out a way to get that debt to income ratio down. So let's go through a quick exercise. So we're going to take a little bit on this, spend a little time on this. So if you're W-2 or even if you're self-employed, right, try to come up with your annual income. Do you know what your annual income is? So for 60,000, 70,000, just take that 70,000 and just divide it by 12. We want to come up with your monthly income. Take that annual. What'd you make last year on your W-2s? What was that gross before deductions, before all those taxes?
Now with this exercise, would you be at including the spouse, since it would be two people on the.
So that's a great question. So whenever you have co-borrowers, if you have a spouse, if they're going to go on the loan with you, all we do is, or co-borrower, whether it's a spouse or even if you have a co-borrower that's not a relative, if you have a co-borrower on the loan, all we're going to do is take your credit. So with the credit, we do a tri-merge and we're going to use the middle score. If you have a co-borrower, we're going to use the lowest middle score of the two, right? So we're taking your credit, we're taking your income, and we're taking your debt, and we're putting everything together. So yes, to answer the question, yes. So if you're getting a co-borrower, go ahead and just do both of them together. Put the debts together, and then, well, first let's just start with the income. Put the income together. Yes. I'm sorry, I give very long answers.
No problem.
Yeah. So get the income, put the income together. Remember, it's the gross. It's before any deductions. So you put that income together and try to come up with, just divide it by 12. Or if you already know what your gross monthly income is, let's start there with that monthly income. So I'll give you a second for that. Okay, everybody good? We good? Yeah, okay. All right, now let's look at the debt. Let's go line by line with the debt. And with the student loan. So, and then I just want to mention, since you did mention spouses, with the different programs, which we're going to go here over shortly, with any government programs, if you're doing USDA, FHA, or you're a veteran and you have a spouse, if you are married, with any of those programs, and you put in the application, it makes more sense to have your spouse on a loan with you, because if you don't, any government programs, we're still going to have to pull their credit and their debt. We're going to have to add their debt to your debt, and your income is going to have to cover both of your debts in the debt to income ratio. If it's with conventional, you don't have to do that. When you have to pull that, your spouse can just show up at closing, make sure they bring their ID, community property state. They'll be on the deed and title. But I want you to think about that FHA, any government loan, it makes more sense. And a lot of times, and I get it, sometimes the spouse credit may not be up to par, but we're gonna need to get it up to par, because if not, we're still gonna have to pull that credit at their debts to your debts. Student loans. So let's go line for line on your debts. So student loans. With student loans, a lot of times, especially right now, what's going on with COVID, those student loans are in deferment. Even if they're in deferment, we still have to calculate something. With FHA, we do have to calculate 0.5% of the balance, 0.5% of the balance. So if you owe 30,000 times 0.5%. $150 I got to add to your debt to income ratio. Okay. If it's a conventional loan, we have to calculate 1% and add it to your debt to income ratio. But for both of them, and that's why I ask people, right, do you know what your payment will be once they come out of deferment? Typically people say, no, I do not know. They've been in there for a while. But before you put your application, go ahead and find out, because your lender's going to ask you for that information because it helps, right? FHA is the best case scenario. They only have to use the 0.5%. But if, let's say, if you do know your number, like you may be on a repayment plan or something like that, or even just call them up and ask them to give you, what's my, if I needed to pay, if I needed to put together a plan, what's the lowest option I have to put in place? And if it's lower than the 0.5%, we can use that lower option to help with your debt to income ratio. So I want to say that about student loans, or if you already know what your student loans, go ahead, add all those up, put it in there. Your car payment, how much is your car payment? Use that. Your credit cards, put them all together. So the credit cards, we use your minimum. I know a lot of times we pay a lot more than that minimum, right? But we calculate your minimum required payment on those credit cards. We add that up. Or anything else, like if you have any anything that it took for them to pull your credit, if you're paying back any personal loans, put that on there. Any furniture loans or anything that you had to pull credit that's going to show up on your credit, put that on there and add it up. So for this particular situation, so Martha's monthly income $6,000. Let's say 6,000. That's her income. So let's say her debt 200 for student loans, 400. Let's say plus 100 for credit cards. All right, that's $700. Now you're gonna take that debt and you're gonna add it to, you're gonna add it to the mortgage. So let's say for a mortgage for a $200,000 house, say your payment will be about $1,600. Okay. So 700. So you're gonna add $1,600 to the debt. So let's just say we're just using the mortgage. The mortgage payment you're trying to get approved for, $200,000, $1,600. You're gonna add the $700 plus the mortgage, $1,600. So that's $2,300. That's the debt plus the new mortgage you're trying to get approved for. So then you're gonna take the debt plus the mortgage, the $2,300. We're gonna divide that into Martha's income. All right, that's 38%, 38.33. So ideally, you want to be below 45%. Conventional can go up to 50%. And if your score is above 640, FHA can go up to 55%. But you typically want to, rule of thumb, you want to be below 45%. So all that means is she's at 38%, she's in a good place. So she has room to go up on her approval amount. So let's say if we went up, let's say 250, 200 instead of $200,000 approval amount, let's say 250, rough estimate, payment would be about $2,100. Let's say $2,100. So then we take her debt, 700 plus 20, hold on, what did I say? 2,100 plus 700. So that's 2,800. We divide that into her gross. So now her debt to income ratio went up to 46%. Now we're kind of getting tight now. Now we're starting to get tight. So when I do the pre-approval, now I want to stop because I at least want to leave some wiggle room because those property taxes and stuff can adjust if we're just doing rough estimates. So that's how we come up with the debt to income ratio. But let's say we try to go higher and now it goes above 50% with conventional. We want to stick with conventional. Now we have to look at, okay, what can we do to get that DTI back down below 50% in approval range? Because with conventional, it's a hard stop at 49.99%. So if you go 50.01, we got to figure out how to get it down, right? So typically, to get it down, first thing people look at, okay, like I mentioned earlier, can we pay off some debt? What debt can we pay off, right? To get that debt to income ratio down. So that's one of the quickest, easiest ways to get the debt to income ratio down. Another way is like, okay, adding income. That's a little bit harder. I know we all would like to add a little bit more. income, to our situation. Where we going? That's because even let's say even if you add a second job, with a second job, we want to at least typically with a second job, we want to see 2 years history with a second job. That you just didn't go out just to get this second job just to get approved. We typically want to see 2 years. If it's 1 year, we kind of have a history, then we can sometimes, but typically 2 years with a second job. So you have to wait for that. If you started a side business, I already said we have to wait 2 years for that. So adding that additional income is not easy unless, or you could do a co-borrower. Now that's a big ask, get somebody else on that loan with you. I don't know. Somebody asked me going to mortgage with them. Whew, that's a one, because now you got this space taking up my debt to end. Now you got this I'm adding 2,000 to my debt to if I want to go buy something, right? So now I have all this room. But even though it's a big ask, I do have a sales pitch for you. So if it's typically it's like because we can do an FHA or conventional, you can do a non-occupant co-borrower. So that's typically like a parent or a relative. They can go on that loan with you and just let them know, hey, if you're not looking to purchase in a year, after a year, since I'm the main person that's going to be on the loan, you're just a co-borrower. After a year, whether it's with conventional or FHA, if they're trying to purchase a home after that 12 months, we just have to show that they've been making the payment for that 12 months and you're and them as the co-borrower, their name is not on your account where the funds are being paid from. As long as we can show that, we can exclude that debt, that mortgage from their profile when they're trying to purchase a new home with a mortgage. But you still have that credit liability. So if you late anytime, it's gonna make an impact. But if you're not, then it's gonna have a positive impact. So all right, so I gave you the sales pitch right there, so you're good to go. So, all right, so that's it. So, those are the 3 ways to kind of get that debt to income ratio down. I'll stop right there and see if we have any questions.
Yes, we did have some in the chat. Okay. So, let me go back. Give me 1 second. Okay, so one person asked what if you get paid cash, but it shows on your bank statements? Do you want to expound how you all handle cash as it, in funds?
You get paid cash. What do you do? Who said it? What do you do?
Isabella, but I'm not sure if she might have popped out because she had,
okay.
She said she has some things going on, but she would, I let her know we would send her the replay.
Okay. So with cash, typically you see that like if it's a business and you get paid cash, typically we want to see as long as you count it on your tax returns, and then we can show that history, similar to self-employed. We're gonna have to show it some kind of way. We're gonna have to show it, and that would be the main way. Such if you're self-employed and you get paid cash. Yeah.
All right. Shamika, did that answer your question? Do you feel comfortable with that answer? And as you asked about student loans, car payments, as it relates to your debt to income ratio?
Yes.
Okay, perfect. And then Isabella made a comment, but I'm not sure exactly what she said. She didn't report this year, but next year she'll be a 1099. So I'm not sure how I think you did explain that with the work history and how you want to view that work history. So I think that is fine. If anybody else has any questions, feel free to drop it in the chat real quick, or take yourself off mute and he can, clarify something that maybe he just covered.
Yeah, just jump on in here.
What about, what about the common side hustles, quote unquote? Like the Uber drivers or the delivery drivers or the medical couriers, there's like the side hustles that a lot of people are doing nowadays just to kind of, make it. Like, are those counted or not really?
They are. We just need that 2-year history, and it needs to be counted. You have to count it first, as long as you count it on your tax returns. And so it's saying we're looking at that as a business, as long as you treat it like a business. And you're, it's showing up on those tax returns, and it's saying we're going to be looking at those deductions. Are you writing off all that income? You can't write off all the income. But we're going to look at the income after deductions and then average it out. And yeah, we could use it. I just had a situation where a young lady. She was just coming up fresh out of school, trying to be a news reporter. She jumped around a little bit, but she's consistently had that W-2 income. Well, on the side, she's worked for her parents it was at a furniture store. And it was an additional $16,000 a year. At first it was W-2, and then the last 2 years it went to 1099. So I said, hey, I need those tax returns. She went ahead and sent those tax returns. Since she did not write off any of the $16,000, we were able to add an additional $1,300 a month to her debt to income ratio. And now she's able to get approved for a higher amount. So you had those side things you can do. You just got to be cautious on how, and your CPA, a lot of times they don't ask. It's a double-edged sword, right? You make the write-offs, it's going to help you tax time, but when it's time to come see someone like me, it's going to hurt you. So a lot of times they don't ask. You might want to tell them like, hey, I'm trying to purchase a house soon. You know, how do we need to do this to make sure I can get qualified? And I talk to CPAs all the time. Send them to me. I can't get too much into the details because there's so much money involved, but at least like what we just talked about, that debt to income ratio, and I already have your application. I already know what your debt like. Miss Borrower, this is what Miss Borrower's debt is. This is what the income is. This is the approval amount they're trying to get to. And just using that, I can tell, hey, I need it to be under 50%. And they should, they're numbers people like us, they should be able to back into it and help you out that way. So yeah, I'm sorry. I get long answers. Yeah.
No, you're okay. Thanks.
I feel like it's a dumb question, but I'm still going to ask it. Once you have an approval amount from the loan company and you go and you find a home that is less than that amount, what does that amount stay with you? Does that go back to the bank, the remaining, or like what happens with that?
Most definitely. First, I'll say there are no dumb questions. What you're thinking, somebody else on the call is probably thinking. So go ahead and ask it. And so that's what Ashley was mentioning, getting those numbers. And so you can be approved for 400,000, but you don't have to use that. You want to be wherever your comfort level. And that's why I take an extra step, which a lot of lenders don't do. When I do the pre-approval, I schedule a Zoom call with you so I can share the screen and we can go over your application. We can go over what that down payment is going to look like, what your monthly payment is going to look like based off of your approval amount. So at that time, if we need to make some adjustments to make sure that we're staying within your budget, we can. So now you know at 250,000, your payment is going to be 2,100. So now Ashley knows, okay, I need to stay within this 250,000 sales price range. We're going to send that pre-approval. It could be for a higher amount, but at the end of the day, it's going to be what you decide to do. And even like Ashley mentioned, as you're going out and looking at properties and finding stuff that you're interested in, it doesn't take much for me. I tell people all the time, just text me an address, email me an address. And now I already have your whole profile. I can see when I do estimates like this estimate here, this is just a rough estimate without a property. This is a random estimate. Well, not random, but good estimates, right? With property taxes and homeowners insurance. But if you have a specific property, that listing is going to have, what those taxes were for last year. It's going to have what the HOA was. And so I can give a better estimate based on specific properties to where you have a good idea. But no, you don't have to spend that money that you've been approved for. Just letting you know we can go up to this amount, and then once you go under contract, then you're getting approved for that specific amount that you need to buy this specific home. So it's a great question.
Yeah, that was a really good question, because we've had situations where people are like, well, they were thinking that they can buy a home for, let's say, 200,000 and let's say they were approved for 300,000. They want to buy a home for 200 and thinking they could take the extra 100 of their approval to do construction or things like that. So no, that you're not the only person who has had that question at all. And
yes. Exactly what I was thinking. I was like, well, maybe people like furnish their house or, the rest of the. Okay.
No, that was a good question. A lot of people have that question because they're like, well, if I'm approved for all this amount, can this be counted as like a construction loan, or can I take some of it to, do other things as I get situated in my house? So no, that was not a stupid question at all. That was actually a very common question that we get a lot of.
And let me stop right there let me talk about that for a little bit. So yeah. When people ask the question of taking some of those extra funds, I just recently had a young lady that wanted to do some repairs to the house. And so she said, well, since I'm approved for this much, can I use those extra funds to go ahead and use it to put new floors in? And so, no, not with a regular FHA or conventional, but they do have loans out there. One is a renovation loan. It's a 203K, like FHA is a 203B. So it's basically a FHA loan. Maximum loan amount is $420,000. So you would have to fit any of those repairs, depending on your approval amount and the sales price. You can roll those the repairs into the loan as long as it doesn't go over that $420,000. So it would be the same process, 30-day process as a regular FHA. Just once the loan process starts, you'll have the contractors go out and do some quotes, and then they'll send it back. Let's say it's $30,000. And at closing, with the title company, they hold it in escrow, and then it's between the agent and the borrower and the contractor to figure out the disbursements and get it done, and they'll release the funds. We can do those, but we don't like to do those. It's just because we do a great job at what we do, right? And so we get you closed on time, and then once you're closed, what we've had happen in the past is once we close, then between the contractor, the title company, and the borrower and the agents, at some point stuff goes left. And now you're associating us with what happened. And so, and it ruins relationships. So we're just like, you know what, it's a lot going on. So it's already a lot going on. So we just try to keep this thing simple as possible. So there are options out there. There are loans available. They call them renovation loans, where you can basically roll those costs into the loan, and they'll just add it to that loan amount so you can get those done. So I wanted to mention that. So what I wanted to show right here is just a breakdown of just an example of a monthly payment. This is just a rough estimate, just some rough numbers. So let's say $250,000. So what we look at, your payment is going to be a breakdown of these few things. So you have that principal and interest. So they come up with the principal and interest by basically, so for example, you have $250,000. If we're looking at FHA, that's 3.5% down. So that's $875 to. So the loan amount will be around $241,000, and they times the interest rate. That's how they come up with the principal and interest. So that principal and interest is basically you're paying back the money that you borrow, and you're paying interest back on the money that you borrow. So that's that principal and interest portion is going to be based off of your loan amount and the interest rate, how they're coming up with that number. Then you're going to have your homeowner's insurance. So your homeowner's insurance is going to insure the home just in case you have a fire or something like that in the home. And so that's just a rough estimate. So based off $250,000, so $125 a month times 12. So it's saying it's a $1,500 annual policy. And so once you go under contract, the processor will ask you to send us a quote that you want to go with. I typically tell people, if you already have car insurance, reach out to that company, tell them you want a bundle, send you some homeowners insurance. Doing that bundle gets you a better quote. Whatever you send us is what we're going to go with. We're going to update your file with the insurance that you're going to go with. At closing, we're going to collect a full year so that you are covered for that entire year. And then also at closing, we're going to collect 3 months worth, that $125 times 3 for your escrow account. Your escrow account is a separate account that the lender holds. So we're going to put that in there. And then every time you make a payment, that portion goes in there. So a year from now, that annual policy that we're paying at closing, a year from now, when it's time for it to be renewed, they're going to pay it directly out of your escrow account to make sure. So you have to worry about it to make sure your home stays insured. So you have that portion of homeowners insurance. Then you have property taxes. So property tax in Houston is anywhere from 2.5% to 3.5%. So I do right, and when I'm just doing a rough estimate based off of the property, I do right at 3%. So 250,000 times 3%, that's $7,500. Let's say divided by 12. 625, and then so let's say 625 a month. So then you have home exemption, homestead exemption, because it's going to be your primary residence. They give you a 20% discount. 20% discount minus 125. So that's how I came up with $500. So so $500 times 12. So it's basically saying your property taxes for the year will be about $6,000 for a year. So similar at closing, same how we do with the homeowners insurance, we're going to collect 3 months of property taxes to go into your escrow account. So at the end of the year, when that lump sum, that $6,000 is due, you don't have to worry about paying that lump sum. We're going to pay it directly out of your escrow account. So that's those property taxes. Mortgage insurance. So the mortgage insurance and homeowners insurance, people get that mixed up. The homeowner's insurance protects the physical house. The mortgage insurance protects the lender. It's not really a benefit for you. It's just depending on the loan amount. It's a requirement. And we're going to jump into loan programs next. But FHA, they have mortgage insurance for the life of the loan, where you're just paying an insurance premium just in case you default on the loan. If you default on the loan, the lender's covered for a certain portion of that loan. They will get some of their money back. Same with conventional. At least conventional, it goes away once you pay down. Conventional, you have the option of putting 20% down. There is no mortgage insurance. But with FHA, no matter what, so let's say you put 20% down, there is no mortgage insurance. So with conventional, you can do a 3% down. And once you pay down 20%, it's like right at 22%, that mortgage insurance cancels out. FHA is mortgage insurance for the life of the loan. Or some lenders may have programs where there's no mortgage insurance. Last place I was at, they had something like that. We don't have any like that now, but they are out there. It's a very competitive market. So that's that mortgage insurance. How I look at it, it gives lenders confidence to loan out these large amounts of money to strangers. Basically, at least they know if you do default, at least they'll get some of their money back. So that's that mortgage insurance. So depending on the program, you'll have it. Typically, you'll have that mortgage insurance. And then homeowners association. So the HOA fee, so the homeowners association, all they do is enforce the rules and regulations for that subdivision. Make sure the grass isn't, you don't let your grass get crazy or your gates falling apart or you color your house purple, or they just, they want the neighborhood to stay looking nice. And so $35, like $500, $400 a year. They send you a separate invoice, but we will put it on the loan estimate. So you'll know any and all fees that are associated with your monthly payment. So typically, maybe the most I've seen, maybe $1,000, $1,100 a year. For HOA, maybe get a little bit higher than that, but it shouldn't be too much higher than that. Unless you're doing a townhome or a condo. My townhome, the HOA fees are about $272 a month. And that will be separate. I have to pay my mortgage and then I'll have to pay my HOA separately. And it fluctuates with different townhomes or condos, so be mindful of that. But it did cover, it covered the water, it covered the shale, it insured the shingles and the siding. So if a storm came through, knocked that stuff off, they would replace it, like the outside gate to the patio. So be mindful of that homeowners association. So I just want you guys to see, right, what that breakdown, and so what can adjust as you're looking at, and that's why I tell people, send me the address, because what I'm going to look at, what are those property taxes? And so I'm going to adjust the numbers based off of those property taxes. Or what's the HOA? So that's why when I get to specific property, I can kind of adjust the numbers so you can see that. So any questions about this?
We had a question come in. It was kind of what you talked about right before you transitioned into this. And they said a comment. Okay, I was denied a USDA loan because of student loans. They said debt to income ratio was high. I'm on a new income driven plan, but they still said they had to go with what I would pay if I wasn't on the income driven plan. So I'm a little confused. Should they have went with what I actually have to pay a month toward my student loans?
That's a great question. If the question was about FHA or conventional, I can answer that, but USDA is not my specialty. It's for those rural areas. I know it is 100% financing. That's a good question. Give me a call. I'll have an answer for you. I know with FHA, if we were looking at FHA, VA, or conventional, then yes, they would have to go with the repayment, the income repayment based plan that you're on if it was a lower amount. USDA, yeah, it's not my specialty. I would have to, give me a call. I could definitely get you an answer for that.
And also, I would like to also note that all loan officers aren't the same and all don't give the same estimate. So just because you may have been declined by one loan officer, or let's say you start your process and you do get declined by one loan officer, that doesn't mean you'll be declined by all of them, because all of them aren't made different. All of them aren't the same, and all of them don't put the same amount of effort into thoroughly going through the loan process. So definitely that's why I would recommend you, getting with Darryl, because I know that he will thoroughly go through your file to set you up for success. If there's any way that he can get you approved, he will do it. So if you were approved with someone else, I would say, let's try. Or if you were saying that you got declined by someone else, I would say, let's double down and let's complete a loan application via Darryl.
And when you do those are like hard inquiries on your credit though, right? So
when did you have, how long ago did you have your credit pull?
no, I haven't. I'm having a general statement. I'm sorry.
No, okay, most definitely. So it is. So rule of thumb is Experian. Once you've done a hard inquiry, I typically say if you're going to shop, which is normal because rates are going up, just do it in a short period of time. If you're going to have multiple lenders do it, Experian. So like I mentioned, we do that tri-merge. You pull from all 3 credit bureaus. With Experian, they give you 15 days. Equifax and TransUnion, they give you 45 days, which just basically means it's only going to be looked at as one hard pull if you do it within those timeframes. So really, don't even think about the 45 days. It's just 15 days. But even if you did, pull, it'll be fine. Now once you get out the 30 days, just don't keep letting a whole bunch of people pull. But if you need to, within a short period of time, even if it's after the 15 days, you want to get a couple different estimates, it's not gonna be like crazy, making your score go down like crazy. So yeah.
Okay, thank you. That was the last one that was in the chat.
Okay. So I feel like I'm gonna have to wrap this up here pretty soon because I gotta talk fast. We talking about this stuff, and it gets. I still got like 20 more slides. Like we can really get into it. So I think I'm gonna touch this, maybe one more, and we're gonna shut this puppy down and take some questions. So we're talking about some programs. So these are just some of the main programs. I always say, let's say whoever you bank with, next time you're in there, ask them, hey, do you have any proprietary, just say proprietary, they call them portfolio, but just say proprietary loan programs for your specific bank. And they may have something that no other bank has, some special loan programs, and that you may be, since you are already a member of that bank, they already have accounts with you where they may offer some kind of incentives, a lower some kind of incentives off the rate or some closing costs or something. So ask that next time you're at the lender. So there are some lenders that have some special, they call them portfolio loans, but these right here, these are the basic programs that most lenders have right here. And so the 2 main that I've been talking about are the top one, FHA, so Federal Housing Administration. Statistics show most first-time home buyers go with FHA. And it's just because it's more flexible. It's more flexible, as you see with the credit score. Typically, they want a 620, but it can go as low as a 580. The maximum loan amount for FHA is $420,000. Actually went up tremendously since last year. And then with conventional, as long as you haven't owned a home in the last 3 years, you can consider a first-time home buyer, and it's 3% down. Or let's say if you have a co-borrower, if at least one person hasn't owned a home in the past 3 years, then they still can be considered as a first-time home buyer. But if let's say you do have a home already, looking to upgrade, downgrade, it will be 5% down with conventional. With FHA, it's only for primary residence, but you can do if you're looking to do like a duplex, triplex, or even a fourplex. As long as you're going to live in one of the units, you can use FHA and do that lower down payment of 3.5%. Conventional, like I mentioned, 3% first-time home buyers, 5% if you already own a home looking to upgrade or downgrade. If you're looking for a second home, it's 10% down, but there are some guidelines with the second home. It has to be a certain amount of miles away from your primary residence, or it has to be like a lake house or a beach house or something like that for it to be considered a second home. If it does not fall in those guidelines, it will be considered an investment property, and you will have to put 20% down for an investment property. So those are the 2 main programs right there. So I want you to write down this with FHA. So with FHA, you have the mortgage insurance for the life of the loan, okay? Rates are typically a little bit better with FHA than conventional. The other big thing about FHA is that they have what is called a upfront mortgage insurance premium. And it's the same purpose. I talked about that in the last slide. I talked about that mortgage insurance that's a part of your payment for the life of the loan. Well, same purpose, but in addition to that upfront mortgage insurance premium, in addition to that mortgage insurance that's a part of your payment for the life of the loan, they also have that upfront mortgage insurance premium. And it's going to show up on the closing costs with those initials. that abbreviation. Now, what it is 1.75% of the loan amount. So let's say 250 times 3.5%, that was at 875. So it's like 241,000. So 250,000 sales price, you take that down payment out, their loan amount is about 240,000, 241,000, whatever that loan amount is, they're going to times it, 241,000 times 1.75%. So that's $4,200. So that $4,200, they give you an option. You can either pay that at closing, or typically with the rest of your down payment or closing costs, remember that 6% of the sales price I mentioned, or what people typically do, they finance it. They just roll it into the loan, right? So, but it's the same purpose as that mortgage insurance. The only difference is the mortgage insurance is part of your payment for the life of the loan, and that upfront mortgage insurance premium is a one-time fee at closing. And all it is that you're paying an insurance premium just in case you default on the loan. How I look at it, FHA says, okay, we're going to make it easier for you to get approved. Even if you have some of these collections, some of this stuff going on, we're going to make the credit score lower, right? We're going to even make the debt to income ratio higher. You can get approved for more. We're going to make it more flexible, but we're going to give you some extra insurance just in case, some extra fees, some extra premium, just in case you default on this loan. So that's how I look at it. So when people are looking at those main two programs, people ask me all the time, well, which one, conventional, FHA, which one should I go with? Which one is the better? Well, you have to, what a lender should be able to do once I have your full profile, just that one application, and I do my Zoom call, I usually go over both. And then I send you fee sheets of both with the whole breakdown so you can kind of compare for yourself. And at the end of the day, that's going to be your call. What's the best one for your situation? A lot of times if conventional, and people can get approved, because I'm telling you, conventional, especially right now with how crazy the market is, the rate's going to be the rate's going to be a little bit higher. But conventional is harder to get approved for. So even though it says 620, I still have sometimes people with a 660 they can't get approved with conventional. It's just harder to get approved for. Particularly if you're around 680, you're good. But and sometimes if you don't have a lot of derogatory items, sometimes with the lower sixes, conventional just doesn't look at mid 600 scores as a good score. So yeah, so if with conventional, if you can get approved for it, you're not gonna, that mortgage insurance is gonna go away at some point, and you don't have that upfront mortgage insurance premium. If you can get approved with conventional and you look at it and it fits what you're trying to do, by all means, go ahead and go with that conventional. And so FHA and conventional, those are the two main programs. And once you go through the process, those are probably the two options that a lender is going to send you. Veteran, if you're a veteran, VA loans are some of the best loan programs out there. One, you see it's no down payment if you're a veteran. There's no mortgage insurance, right? Minimum 620 credit score with VA. And then with VA, they don't have a max. If you're below 620, you do have a maximum debt to income ratio. But with VA, you don't have a max debt to income ratio with VA above 620, at least not with us. So VA loans, very good. Jumbo loan is, so conventional, the maximum loan amount with conventional, $647,000. Anything over that loan amount is considered jumbo loan. So that's your higher price sales prices. So with jumbo, we can do typically, once you get over they call it conforming limits. Anything over conventional loan limits, now you're looking at 15-20% down. There are some programs where you can do 5% down up to $850. But typically they want at least 10% down. Your score is a little bit higher. Typically they want to see you over 700 credit score. So whenever you hear jumbo, just know, okay, you're talking about those higher sales prices, higher loan limits, and then the down payment assistance. So I will be the first to say, so like I said, every loan officer is different. Different loan officers have their specialties. Some loan officers don't do down payment assistance at all. And then there's some that specialize in, there's so many different, like city of Houston, there's different counties. I'm not the specialist. I do all of these, right? I do them very well, right? I know the guidelines, but we have added a couple of the down payment assistance programs. So TSHAC is one. I just pulled this off of their site today. So with the regular FHA conventional, as far as pricing, it's like with the rates, we'll pull up each day. I have to pull up a rate sheet. I should have put that on there. the rate sheet to see where rates are today. The rates are going up right now. And I don't know if I should let this be the last night, but rates are definitely going up. It's the hot topic right now. I'm doing these Zoom calls. I try to keep it light. I'm trying to laugh with people. You can see the stress in people's faces. The rates are going up, but it is what it is. It's fine. You know, we have been spoiled with these low rates for some time now. The good thing to remember is that they're still low, like 5-6%. It is still low compared to where we've been in the past. But I said that to say, so with FHA and conventional, we have to go and look at the rate sheet. And the rate sheet is going to be based off one of what's going on in the market. And then type of loan program you have. FHA or conventional rates are different. Like I mentioned, conventional rates are a little bit higher. Right now, FHA, you're probably looking at 5.125 for regular FHA. Conventional is going to be a little bit higher, closer to 6%, maybe a little bit under with conventional. And then VA is going to be similar to FHA. With down payment assistance rates are always typically a little bit more than whatever the market is for FHA and conventional, because they're like, okay, we're going to give you this assistance, but the higher rate is like basically them saying this is how you're going to pay us back, basically, is with this higher rate for this assistance that you need. And so when you notice here, so we have to go to their website. If we're looking at rates, we can't look at our pricing sheet. Our pricing sheet, we'll look at what today's rates are, and it'll stop at a number. Let's say with FHA, it'll start at 5.125, and it'll show at par, just meaning there's no charge for this interest rate. But then people ask, are there options for buy down rates to buy down the rate, which is basically you're just paying an additional fee to lower the rate. And it'll say, okay, yeah, if you want to lower your rate from 5.125 to 4.5%, you'll have to pay, just for the sake of numbers, an additional $4,000 or something like that. Well, when we're looking at different down payment assistance options, we can't do that. We can't look at our pricing sheet. We have to go to whoever down payment assistance program it is. Like this one is T-Shack. We go to their site and we have to look every day. We have to look at what their pricing is. And you can't, whether it's regular pricing or down payment assistance, you can't lock in the rate until you have an executed contract. And so once you have that executed contract, then we have to go back here and look at where the options are. And so as you can see here, a lot of them are missing right now, and it's because of the volatility in the market right now. And so typically all these will be filled in. So let's say even that first row where it says a grant. So minimum credit score is 620 with FHA, VA, or USDA. So basically the grant is, as long as you stay in the home for at least 6 months, you don't have to pay the grant back. And so typically, so we're gonna say here, 2% DPA, that's 2% down payment assistance. That's 2% of the loan amount. And so with the different options, you have to go with whatever rate is listed for that option. So for example, if you wanted the 2% option with the grant based off of today's pricing, if you wanted a contract today, you would have to lock in at 6.5% at 2% of the loan amount. So for example, if the loan amount was at $250,000, after the down payment, the loan amount is $241,000 times 2%. The down payment assistance will be $4,800. So you have the grant. And so typically you'll have an option here for 3%, 4%, and 5%. The 5% was really helpful, but now the rates have been going up. So this has been going on for a couple of weeks, and a lot of the programs are all like that right now, where they don't have the options available at this time, but they said they should be coming. So the other option is the 3-year deferred forgivable second lien. So it's basically, it will be the same. Let's stay at the 2%. It would be the same amount, that $4,800, 2% of the loan amount, but instead of it being a grant to where you only have to stay in the home 6 months and it's completely forgiven, they're now, for that 2% of the loan amount, that $4,800, they're going to put it as a second lien, right? The first lien is going to be that $241,000. First lien always takes priority. And then the second lien position is going to be this 2% down payment assistance that's going to go towards helping with their closing costs. So now the 3-year deferred forgivable second, they call it a soft second because there's no interest rate on it. You don't have to make any payments on it, and it's completely forgiven as long as you don't sell or refinance within those 3 years, within this 36 months, that 36, a 3-year anniversary. So as long as you don't sell or refinance within those 3 years, it's completely forgiven. Also, that 2% is completely forgiven. And then every month that you stay in the home, 1/36 of that second lien is forgiven, right? Up until the 36 months where it's completely forgiven. So for example, if we looked at the 2%, we divide that at 2% of the loan amount of $241,000 comes to $4,820. Divide that by 36, that's $133. So every month that you stay in the home up to the 36 months, $133 of that $4,800 is forgiven each month, all the way up until the 36th month, and then it's completely forgiven. But let's say halfway through, a year and a half in, you want to refinance or you want to sell. Well, now only half of that second has been forgiven. So now you have to pay back half of the $4,820 divided by 2. So you have to pay back $2,400. So that's typically, and a lot of the down payment assistance programs work like that. I like this one because with this one, the income limit is $99,000. So that's whether it's one borrower or two. But Seth is another one that we added is very similar to this. The credit score is a little bit higher for FHA, it's at 640. The income limit goes a little bit higher to like 112,000, but the debt to income ratios are a little bit more conservative. So if your score is between 640 and 680, the maximum debt to income ratio is 45%. If your score is above 680, then it goes up to 50%. Whereas with this one, with FHA and Conventional, they go off of whatever our desktop underwriting, whatever our guidelines are. So with FHA, we can go up to the 56% with FHA, and then Conventional still stops at, as long as your score is 640, still stops at 50%. And so in the past, it has been super helpful. When these rates start getting a little crazy. So like we just had a closing a couple weeks ago where they did when the 5% was available. Because if you think about what I mentioned, I said, okay, 6% of the sales price, that's your down payment and closing costs. Well, if they do 5%, then that would take up a huge chunk of that out-of-pocket expense. And so we had someone that they were relocating from California. We used their expected income. Income wasn't going to start till a month after closing. It was about a $20,000 increase. So we were able to use that. And they did 5%. So they still had to pay their earnest money that they got a credit for. At closing, it came to the table like $194. So it can be extremely helpful. It's just, you just got to look at the options. And so, yeah, when I do the Zoom call, we kind of plug in the numbers, see how these higher interest rates and, it does make a huge dent in that out-of-pocket expense, bringing the closing table. You just have to look at and just compare to just not doing any down payment assistance. Okay, what is the rate? What does my payment look like? What is my out-of-pocket expense? That estimated cash to closing, which is basically they're going to sum up everything. Your down payment, closing costs, this is how much you have to bring to closing. What is that going to look like? And you just have to compare and just see what makes sense. So yeah, I think we're over time. I think that was good for we talked about programs, credit and stuff, work stuff. I think we talked about a lot. I think we've had enough excitement for one Saturday. So I think I'll end right there. And are there any more additional questions?
And if it can be about anything as it relates to the process, literally anything, because I know a lot of people have different questions. So I know we covered a lot today. So if you literally have any questions about any aspect of purchasing a home, obtaining a loan, definitely feel free to just go ahead and take yourself off mute and ask us those questions. And
I'm not gonna, for me, it's a lot. It really is. Like when he got to talking about the numbers and, as far as the loans and everything, I mean, it's just a lot. So, obviously for me moving forward, I'm going to be meeting with everybody, to kind of get more, like of the breakdown. But yeah, it seems overwhelming, like as a first time home buyer, it really does.
It does seem that way. So the thing I tell all of my clients is all of the stuff you don't have to remember. We just want you to be slightly educated as you go throughout this process. So like as we go, even from under contract, every single step of the way, you get an email from me telling you, okay, this is where we're at. This is what's happening, on top of the phone calls. Like, most of my clients, they call me so much. I'm like, I'm not just a realtor. I end up being like a counselor, helping them just to kind of guide them to make the decision. So the good thing about it is you don't have to necessarily literally just take each step by step. And it feels overwhelming because you're like, how can I get from here to here with all of this information? And literally just, we're going to line it up, knock them down one by one. Whereas it's not going to feel like this as you get into it. Generally, especially as it relates to like the loan process, he kind of wants to give an overview of like different programs, but essentially what that will look like for you is you will complete the loan application, submit the requested documents, and then he literally gets on a Zoom call with you and says, okay, so based on your credit portfolio, the documents that you submitted, this is what I see. So all those other programs that don't apply to your profile, he's not even going to discuss those. So you don't even have to be like, oh, do I need this? Do I need a conventional? You don't even have to, because some of the programs, your credit profile will automatically eliminate you from for different reasons, whether it be too much income, too little income, a 580 credit score, a 680 credit score, so a lot of it, your profile automatically kind of places you somewhere in there. Don't even think like, oh my God, do I got to know what this loan is? Nope. You complete your loan application. And once you complete your loan application and give the documents, he jumps on a Zoom call with you and breaks down like, all right, this is what I see. This is what's happening. Do you have any questions as far as, is there a certain amount you want to get qualified for? Okay, let's see how we can work towards that amount if it's not that amount. So don't think of it as that, because actually most of my clients, after they finish with myself, they're like, I feel like I could be a realtor. I feel like I could do this. I know, because I'm literally explaining everything to you as we go. I'm not going to tell you about the appraisal if we just home shopping right now. That's not what we're going to focus on. We're going to focus on the chunk and the step of where we're at each step of the way. So classes like this are really to give you an overall view of what is happening. So for instance, I'm a realtor. My best friend was purchasing a home in Vegas, and she forgot, so people who live out of state, I still pair them with like my partner agent and vet them out just to make sure like it's a really good agent and they know what they're doing. So for example, my best friend was purchasing a home in Vegas, and she was like, should this happen? Because should this happen? Should this look like this? Well, she didn't do any type of like home buying class before. And also her realtor didn't do like a one-on-one consultation with her to explain what to expect next. So that's why it felt so overwhelming for her. So when you have classes like this, let's say you went with another realtor, you would know if something didn't sound right. You would know if something, if this wasn't something I heard before, or you'll be like, oh yeah, I heard about that. This legit. This is how it's supposed to go. So don't be overwhelmed, because everything is going to be broken up literally step by step. And even still, like, if you go to my Instagram page, I have different like supporting, helpful checklist documents, ebooks, guides, just to really walk you through this process so you can take it step by step, read as much as you want, go back and reread so that you feel really confident and not overwhelming. And that is the key to a really great team. So myself and all the vendors that I work with, you're going to be like, oh my God, that was the smoothest process. It felt like a lot having to, keep submitting these documents, but literally, like, it's not as bad as it seems. It just felt like that because he explained there's different people on the call. So somebody may, they may be listening for conventional. Somebody else may be listening for down payment assistance. Somebody else may be listening for jumbo. So he just wants to make sure he touched those. But once you do your loan application, we are like zero, like zoned in literally specifically for your needs and what only matches your profile.
And I like to add to that. And then also, like, this is it's like a new relationship. Now you have us as your real estate and lender. Like me, I give all my folks like this was listed right here. This is my cell. Like, this is my work cell. So now, we do that initial application. And then I take that time. The Zoom call could be 20, 30 minutes. Sometimes it lasts over an hour, just to make sure we're taking as much time as we need as we're going over these different pages in your application and the numbers to answer any questions that you have. And a lot of times, sometimes it's a lot, but at least you have that. And now you process it. And then you're like, okay, now you're texting me, the next week, or, hey, can we jump back on a call? Or this is the question, you're texting me questions. So you'll have that. It's a long lasting, like, I want to do your next 3-4 mortgages. So,
right.
So this is a long lasting relationship. So it's like, now you have these experts on your side to where, over time you can get all your questions asked and get a comfort level with everything. So.
All right.
She like,
all right.
Yeah.
We promise. We got you.
Yeah. I'm feeling, I don't know. I mean, we'll definitely work toward it. That's for sure. That's for sure. So I appreciate it.
You're welcome. Does anybody else have anything they need? Any questions, comments, concerns, anything?
Now's the time.
If not, we definitely thank you all for attending. We thank you for staying on with us. We know we went a little over, but we definitely just want to make sure we give you the information that you need and you don't come here feeling empty, like, dang, I wasted my Saturday. So we hope you gave you tons of information. If you go to my Instagram page, you have tons of information. I'm going to put my Instagram name in the chat. Free resources that you can get that pertains to getting ready and then while you're ready. So there's different guides just preparing you for this process. So definitely check out those different free resources for us. And we definitely thank you so much for staying on with us this entire time. And we hope that we will be connecting soon. And if that is it, bye everyone. Thank you so much for joining.
Thank you.
All right. Thank you. Y'all have a good one.
You too. Bye.